287,432 contracts. That is the net short position held by commercial traders in silver futures as of Friday's close. 287,432 contracts. Each contract represents 5,000 ounces. That is 1.4 billion ounces of silver sold short by the largest banks and financial institutions in the world. Let me put that in perspective. Total global silver mine production is 820 million ounces per year. The commercial traders have sold short nearly 2 years of global production. They have bet against more silver than will come out of the ground in the next 24 months. This is not normal positioning. This is a record. The largest commercial short position in the history of the CFTC data going back to 1986. Larger than before the 2008 crash, larger than before the 2011 peak, larger than before the 2020 COVID dislocation. The biggest bet against silver ever recorded. Commercial traders are not speculators. They are JP Morgan, Goldman Sachs, HSBC, Bank of America. They are the banks that control the precious metals markets. They are the institutions with direct access to Federal Reserve officials. They are the insiders who always seem to position correctly before major moves. When they build a record position, they know something. They see something coming that we do not see yet. The question is what? Let me show you exactly what the CFTC data reveals, what it has predicted historically, and why this record short position could mean the biggest move in silver is about to begin. To understand why the CFTC data matters, you need to understand what the Commitment of Traders report actually measures. Because this is the closest thing to a crystal ball that exists in commodity markets. Every week, the Commodity Futures Trading Commission, the CFTC, publishes a report called the Commitment of Traders, or COT. This report breaks down who holds what positions in futures markets. It separates traders into categories based on their role in the market. The three main categories are commercials, large speculators, and small speculators. Commercials are the producers, processors, and merchants who use futures to hedge their business operations. In precious metals, this category is dominated by the bullion banks, JP Morgan, HSBC, Scotia. These are the institutions that deal in physical metal and use futures to manage inventory risk. At least, that is the official explanation. In practice, the commercial category is where the manipulation happens. These banks do not just hedge, they speculate, they take directional positions, they use their massive size and market access to influence prices. They are consistently on the winning side of trades because they can see order flow that nobody else sees. Large speculators are hedge funds and managed money. They are trend followers, momentum traders. They buy when prices are rising and sell when prices are falling. They are consistently on the losing side of major turns because they chase rather than anticipate. Small speculators are retail traders, individual investors, day traders. They are the least informed participants. They are the liquidity that the large players extract value from. The historical pattern is remarkably consistent. When commercials are heavily short and large speculators are heavily long, the market is near a top. Commercials are selling to speculators at high prices. The price then falls. Commercials cover shorts at a profit. Speculators lose. When commercials are lightly short or even net long and large speculators are heavily short, the market is near a bottom. Commercials are buying from speculators at low prices. The price then rises. Commercials profit. Speculators lose again. The commercials always win, always. Over any extended time period, the commercial position is the single best predictor of future price direction. Not fundamental analysis, not technical analysis. The COT report. This is why the current record short position is so significant. If commercials are always right, what are they positioning for? Let me walk you through the specific numbers in Friday's COT report, because the details reveal the magnitude of what we are seeing. In silver, the commercial net short position stands at 287,432 contracts. This is the gross short position minus the gross long position. The commercials are net short 287,432 contracts times 5,000 ounces, which equals 1.437 billion ounces. To understand how extreme this is, let me give you context. In December 2023, the commercial net short was 42,000 contracts. Today, it is 287,000 contracts, a six-fold increase in 18 months. The position has exploded. In March 2020, at the peak of COVID panic, the commercial net short fell to only 18,000 contracts. That was a washout bottom. Silver was $12 and about to rally 150% to $30. In April 2011, before the silver peak at $49, the commercial net short reached 82,000 contracts. That was the previous record. Today's 287,000 contracts is 3.5 times larger. In October 2008, before the financial crisis bottom, the commercial net short was 53,000 contracts. Today's position is 5.4 times larger. There is no historical precedent for the current positioning. It is off the charts. Literally, the chart of commercial short positions looks like a hockey stick. Decades of relatively stable positioning, then a vertical spike in the past year. Now let me show you the other side of the trade. Who is taking the long side? Large speculators, the hedge funds and managed money hold a record long position. They are betting heavily that silver will rise. They are buying what the commercials are selling. The large speculator net long position is 241,000 contracts. This is also a record, higher than 2011, higher than any previous reading. Small speculators are also net long, but their position is less extreme. Here is the setup in plain English. The banks are selling. Record amounts. The hedge funds are buying. Record amounts. One side is going to win big. One side is going to lose everything. Historically, the banks win. But let me show you why this time might be different. Now let me break down the gold caught data because it shows a similar pattern. In gold, the commercial net short position is 198,743 contracts. Each gold contract is 100 ounces. That is 19.8 million ounces short. Nearly 620 tons of gold sold short. Annual gold mine production is approximately 100 million ounces. The commercial short represents 20% of annual global production. Extreme, but not as extreme as silver. The gold commercial short is elevated, but not at record levels. The silver positioning is more extreme. This tells us that the setup is most significant in silver. Silver is where the action will be. Now let me show you the concentration data because this reveals who exactly is doing the selling. The CFTC publishes concentration ratios showing what percentage of the short position is held by the largest traders. In silver, the four largest traders hold 42% of the entire commercial short position. The 8 largest traders hold 56%. This concentration is extraordinary. 4 banks control 42% of the short side of the silver market. This is not a diverse market with many participants. This is a controlled market dominated by a handful of institutions. We know from previous legal cases that JP Morgan has historically held the largest position. They paid $920 million in 2020 to settle manipulation charges. The manipulation was documented. The spoofing was proven, and yet they remain the largest participant in the silver market. The record short position is not being built by hundreds of hedgers protecting their mining operations. It is being built by a handful of banks who have been caught manipulating the market and paid nearly $1 billion in fines. That should tell you something about what this position represents. So what do the commercials know? Why are they building the largest short position in history? There are 3 possible explanations. Explanation 1, they expect prices to fall. This is the straightforward interpretation. The banks see something bearish that the market has not priced in. A demand collapse, a supply surge, a deflationary shock. They are positioning to profit from a coming decline. If this explanation is correct, silver is about to crash. You should sell. You should wait for lower prices. The banks know more than you, and they are betting heavily against silver. But there is a problem with this explanation. Silver has already risen significantly since the banks began building this short position. In December 2023, when the commercial short was 42,000 contracts, silver was $23. Today, silver is $31. The price has risen 35% while the banks have been selling. The banks are not winning, they are losing. Their short position has generated massive unrealized losses. At current prices, the commercial short position is underwater by billions of dollars. This does not look like informed positioning. This looks like desperation. Explanation 2. They are hedging physical exposure. The official purpose of commercial hedging is to offset risk from physical inventory. If a bank owns 1 billion ounces of physical silver, they might sell 1 billion ounces of futures to neutralize price risk. But here is the problem. We know from regulatory filings and vault data that the bullion banks do not hold anywhere near 1.4 billion ounces of physical silver. Total COMEX registered inventory is 28 million ounces. Total LBMA silver is approximately 800 million ounces. The short position exceeds the total identifiable silver in the entire Western banking system. They are not hedging physical they own. They are selling silver they do not have. This is naked shorting. This is speculative positioning disguised as hedging. Explanation 3. They are trapped and cannot exit. This is the explanation the banks do not want you to consider, but it is supported by the evidence. The banks have been short silver for years. They have suppressed the price through coordinated selling. They have profited when prices fell and covered shorts at lower levels. The manipulation has worked for decades. But something changed. Physical demand exploded. Industrial consumption surged. Investment buying accelerated. The price started rising despite their selling, and now they cannot cover. If the banks try to cover 287,000 contracts, they would need to buy 1.4 billion ounces of silver. There is not 1.4 billion ounces available. The buying would send prices parabolic. Their losses would multiply with each purchase. They would be buying at higher and higher prices until they were wiped out. This is called a short squeeze. And the setup for the largest short squeeze in precious metals history is now in place. The commercials are not building a record short because they know something bearish. They are holding a record short because they are trapped. They cannot exit. They can only add to the position and pray that prices fall enough for them to escape. Historical precedent 15 Sun to 18 Sunner. Let me show you what has happened historically when commercial short positions reached extreme levels. Because the pattern reveals what is coming. The commercial net short in silver peaked at 53,000 contracts in March 2008. This was considered extreme at the time. Silver was trading at $21. Over the next 6 months, silver collapsed to $8.50, a 60% decline. The commercials covered their shorts at a massive profit. The large speculators were destroyed. But then something happened. The commercials began rebuilding shorts as silver recovered. By 2011, they were heavily short again, and this time, they lost. The commercial net short reached 82,000 contracts in April 2011. Silver was trading at $49. This was the peak. What the standard narrative misses is that the commercials had been short throughout the entire rally from $15 to $49. They were short at $15, short at $25, short at $35, short at $49. They did not predict the top. They were fighting the rally the entire way. They just happened to still be alive when the rally finally exhausted itself. Their profits from the subsequent decline did not offset their losses from the rally. Multiple banks took significant losses in 2011. The manipulation nearly failed. The commercial net short dropped to only 24,000 contracts after a prolonged bear market. Silver was 1380s. This was a setup for buying. Over the next 4 years, silver rallied to $30. The commercials covered at lower levels and rebuilt shorts at higher levels. They survived, but the position sizes were smaller. The manipulation was easier. The commercial net short collapsed to 18,000 contracts in March 2020 during COVID panic. Silver was $12. This was the ultimate buying signal. Over the next 5 months, silver rallied to $29, a 142% gain. Anyone watching the COT data could see the setup. Minimal commercial shorts meant minimal selling pressure. The path higher was clear. Today, the commercial net short is 287,000 contracts, by far the largest in history. Silver is $31. If the historical pattern holds, this extreme positioning should lead to a commercial victory. Prices should fall, the banks should cover at a profit, but the historical precedents did not involve position sizes anywhere near this extreme. The banks have never been this short, they have never been this exposed, and the physical market has never been this tight. The setup for a commercial failure is unprecedented. If they cannot force prices lower, if physical demand continues overwhelming paper supply, if the large speculators refuse to fold, the squeeze will be historic. Let me explain exactly how this CFTC data affects you personally, because this is not just interesting market analysis. This is actionable information that could determine your financial outcomes. First, the extreme positioning signals a major move is coming. Extreme COT readings precede extreme price moves. This is not contested. It is historical fact. Whether the move is up or down, it will be significant. Moderate COT readings produce moderate price action. Extreme COT readings produce extreme price action. A record short position will be resolved through record price volatility. Prepare for major moves in silver over the coming months. Second, the direction depends on physical versus paper. The commercials win when paper supply overwhelms physical demand. They sell futures, prices fall, they cover, profits booked. But they lose when physical demand overwhelms paper supply. They sell futures. Prices rise anyway because buyers take delivery. They cannot cover because there is no physical to deliver. They are trapped. The current evidence suggests physical demand is overwhelming paper supply. Premiums are elevated. COMEX inventory is draining. Shanghai premiums exceed Western prices. Miners are withholding supply. The physical market is tight and getting tighter. If physical continues dominating, the commercials lose. The record short becomes the record loss, and silver prices explode higher. Third, you are watching the battlefield live. Most market manipulation happens in darkness. You never see it. You never know it happened. But the COT data provides a window into the war. Every Friday, you can see what the banks are doing. You can see their positioning shift. You can see whether they are adding to shorts or covering. You can track the battle in real time. This transparency is rare. Use it. Monitor the COT data weekly. When you see the commercial short start declining, when you see them covering, that signals the end of the current phase. Whether they are covering at a profit or loss will determine what comes next. Fourth, your decision to hold physical is validated. The commercials are short paper silver. They are not short physical silver. They cannot be. When you own physical silver, you are outside their game. They can manipulate the paper price, they can slam futures, they can trigger stop losses, but they cannot take your physical ounces. The COT data shows who is on each side of the paper trade. You want to be on neither side. You want to be holding physical while the paper combatants destroy each other. When the smoke clears, physical holders win regardless of which paper side prevails. Fifth, the resolution will be violent. Record positions require record resolution. The banks will either crush the price to cover their shorts at a profit, or they will be crushed as the price rises and forces them to cover at catastrophic losses. There is no gentle unwinding from a 287,000 contract short position. The move will be fast and extreme. Multi-dollar daily moves. Limit up or limit down. Chaos. Position yourself before the resolution, not during it. So how do you position based on the CFTC data? What actions should you take when the commercials hold a record short? Step 1. Recognize that the record short is ultimately bullish. This is counterintuitive but critical. Record shorts mean record fuel for a rally. Every short position must eventually be covered. Every contract sold must eventually be bought. The 287,000 contracts short are 287,000 contracts of future buying pressure. When the commercials are forced to cover, they become aggressive buyers. Their covering drives prices higher. The largest shorts in history create the largest short squeezes in history. The fuel for the rally is already loaded. The only question is when it ignites. Step 2. Accumulate physical silver while the commercials suppress the price. The paper manipulation is providing you a gift. The banks are holding the price artificially low by selling futures. This gives you the opportunity to buy physical at discounted prices. Do not fight the gift. Accept it. Every ounce you buy at suppressed prices is an ounce that will revalue when the suppression fails. If you have $500, buy 15 ounces of silver now. Lock in current prices while the commercials are still selling. If you have $2,500, buy 70 to 75 ounces. Build a position that will benefit significantly when the short squeeze arrives. If you have $10,000, buy 250 to 300 ounces of silver and add 1 ounce of gold. Diversify but wait towards silver, where the COT setup is most extreme. If you have $50,000, allocate $12,000 to $15,000 to physical metals. Buy 400 to 500 ounces of silver and 2 to 3 ounces of gold. Consider private vault storage for security. If you have $100,000 or more, target 20% to 25% in physical precious metals. Weight heavily towards silver given the record commercial short. This is the generational setup. Step 3. Avoid paper silver entirely. The COT battle is happening in the paper market. If you own SLV, you are caught in the crossfire. If you own futures, you are directly exposed to the manipulation. The commercials control the paper market. They cannot control the physical market. Own physical. Stay out of their game. Step 4. Monitor the QT data weekly for signs of commercial covering. The CFTC releases the QT report every Friday afternoon. I track it and share analysis on this channel. Watch for declining commercial shorts. When the short position starts shrinking, the banks are covering. If they cover while prices are low, they are winning and a decline may continue. If they cover while prices are high, they are losing and the squeeze is accelerating. The direction of price while the commercial short declines tells you everything about who is winning the war. Step 5. Be patient, but stay positioned. The COT setup does not provide precise timing. Extreme positions can become more extreme before resolving. The commercials might add another 50,000 contracts before the squeeze begins. Do not try to time the exact bottom or top. Stay positioned in physical throughout the process. When the resolution comes, you want to already own metal. You will not be able to buy during the squeeze. Dealers will be sold out. Premiums will be astronomical. Position now. Step 6. Understand that the squeeze may not happen smoothly. The commercials have tools. They can raid the market at thin liquidity hours. They can change margin requirements. They can invoke force majeure if delivery fails. They will fight. But they cannot create physical silver from nothing. They cannot deliver metal that does not exist. They can delay the reckoning. They cannot prevent it. The physical deficit is real. The short position must eventually be resolved against finite physical supply. Time is on your side. The commercials are running out of runway. 287,000 contracts short. The largest position in CFTC history. 1.4 billion ounces of silver sold by banks that do not own it. Either they know something bearish that justifies this unprecedented bet, or they are trapped in a position they cannot exit. The evidence points to trapped. The price has risen 35% while they sold. The physical market is tightening. The COMEX vaults are draining. They are losing money every day this position remains open. But there is one specific event on the calendar that could force the resolution. It happens every quarter. It is called the delivery month. And the next one is the most dangerous for the banks in years. I break down exactly what happens during delivery month and why the commercial short position faces its greatest test in this video right here. Click it now. The record short is fuel for a record squeeze. Make sure you understand when the match might be lit. I will see you there.